you should know is that no one makes things in the suburban cul-de-sacs. All the places people are borrowing from in the 19th century, these land exchanges, are for farms, where things are made, where profits are made. It's productive borrowing, not unproductive borrowing for a suburban cul-de-sac house. And when thinking about that small example, we should rethink about what it means to have debt in the 20th century. It's indeed within this framework from the movement away from an agricultural and manufacturing economy towards a service economy over the 20th century, that many of these questions of, well, why do you lend money to these people? How does money get made? Get answered. It's only by understanding this not as an isolated, perhaps moral phenomenon of derelict consumers gone mad with their credit cards, but rather as a structural condition of capitalism, that we can really understand where this debt comes from and why people are so excited to lend it to us. It's not a story of malfeasors, but one of markets itself. So I was asked to give a quick sketch of mortgages in the 20th century, and so I'm going to do that because I like to do what I'm told. And we're going to start off in the 1930s, but it's in the 1930s that we see the real difference between this older form of mortgages and the form we take almost for natural and granted. For the kinds of mortgages in the 1920s, as late as early, depending on you look at it as 1920s, or when things are quite different than they are now. When you borrowed a mortgage, they were short. The much vaunted balloon mortgages that people think have been invented in the past few years actually were very widespread in the 1920s. These interest-only mortgages that were paid off in full, or were meant to be paid off in full after only a few years, were quite widespread in the 1920s, and to a large degree were responsible for the mortgage crisis of the Great Depression. They all came due in one brief moment. And lenders thought, why should I roll this debt over? Why should I provide more debt? No, I'm going to pull it out. And suddenly, there was a crisis. And this is what we're responsible for the need for, the Homeowners Loan Corporation we all learn about. But few of us understand that it grew out of the very structure of the instrument itself. So in many regards, this kind of crisis has been seen before. And it was only through the intervention of the state in the FHA that this kind of instrument was remade into the way we think of how mortgages ought to be structured today. They were remade into long-term loans. Rather than 3 to 5 years in length, they became 15 years long or more. Instead of being paid off at the end of the term in full, they were amortized. So you pay off both the principal and the interest slowly and over time. They were transformed from a short-term debt into a long-term investment. And it was the government that made this happen. It was the government that intervened. It was the government that created insurance policies so that banks could be drawn into this lending system, kicking and screaming against their will, but only because they saw there was profit to be made and risks were minimized. Now, of course, as many of you know, there were many other systems for creating housing in the 1930s that many historians have liked to focus on, the PWA and sort of the creation of housing for low-income Americans. But these programs, while often the focus of our historiography, were not that important in comparison to things like the FHA, and even in the 1930s. They were much smaller in scale. The government had to provide every dollar that was invested in these schemes, whereas for the FHA, it was completely private. And while perhaps the private markets aren't as concerned as many politicians would be for low-income Americans, they do have many more resources, billions and billions of dollars rather than just millions of dollars. And by the end of the 1930s, there were 10 times the housing produced through this marshaling of private capital than there were through government direct programs. It was the ability of the government to harness capitalism that made housing available for all those people who never had houses before. It's also in the 1930s that we see the origins of Fannie Mae, a charming name that many of us are only recently familiar with, then called FNMA, the Federal National Mortgage Association, as it is today, but without the colorful name. It was Fannie Mae that provided the ability to trade loans for the very first time. These loans could be traded across the country on a secondary market. Now, why is this important? Well, think about the big difference between how debt worked at the end of the 19th century and it works today. Think about how it all happened, right? Loan sharks in back, dark, dusky rooms, bartenders lending money across a counter, private personal relationships. Many of the mortgages that occurred in the 1920s were private personal relationships. What these federal loans allowed for was standardization and fungibility. A loan in the Southwest United States could be understood by a Northeastern banker for the very first time. And Fannie Mae allowed that capital from the Northeast to be invested around the country. But in the process, loans become institutional. And these institutional owning of mortgages is crucial to understanding this big change. And it seems natural to us, but in fact it wasn't. In the post-war period, it's actually a very familiar story to all of us: suburbanization and mortgages. And these VA and FHA loans, federally insured, favor suburbanization in ways that should be familiar to all of us who studied the 20th century. Tom Segru's book, for instance, The Origins of the Urban Crisis, is still, I think, a classic in this regard. But what is perhaps less known is that mortgages, when people borrowed mortgages for these houses, they tend to borrow in other aspects of their lives as well. In fact, this entire suburban landscape was predicated on borrowing, though the people who were adults during that period will never tell you that over casual dinner conversations. They always say, "Oh, I never borrowed," or "My parents never borrowed." In fact, they all borrowed, or at least that's what the numbers tell us. In fact, they borrowed so much for their cars and at their department stores, at their houses, that the boom in American personal borrowing should be traced to this exact moment. And in fact, those with mortgages tended to borrow more after you adjust for race and location and income and wealth and every other pertinent factor you can possibly imagine than anyone else. They borrowed many, many, many more dollars than anyone else. Mortgages were part of a lifestyle of debt that developed even in the midst of prosperity. But what was different about the post-war period than perhaps now was that their jobs grew just as quickly. Their wages grew just as quickly. They borrowed more, but they paid more back. Now, coming to the third stage of our story, we look to the year 1968, a year that is probably an incredibly pivotal year for understanding what we're in today. And in 1968, as part of the Great Society, there was the creation of the first mortgage-backed securities in the Housing Act of 1968. It was thought that pension funds, which had increasingly acquired larger and larger shares of America's capital resources, would be more willing to invest in mortgages than insurance companies and other older institutional investors. And at the same time, these mortgage-backed securities could then be used to channel funds into America's cities, which, as you all know, had been for several years the recipient and had been many urban riots, and much property had been destroyed. And it was thought that if cheap mortgage funds could be made available, then the cities would stop burning. If people could borrow, they could acquire their stake in American capitalism. And so through these funds, money was made available for something called the Section 235 program. Now, after a couple of years, this folded under conditions very similar to what we see today. Predatory loans, people being tricked, shoddy housing, everything that goes wrong with an unregulated set of loan procedures, which they were very much unregulated. But the mortgage-backed security survived. And by the 1970s, in some quarters of the year, mortgage-backed securities provided up to half all available funds for the U.S. market. This is huge, because it tells us a couple of things. One, that mortgage-backed securities are crucial to the operations of what we take to be prosperous times. And they, in fact, can function quite well and have been necessary for 30 years. They're not just the inventions of hedge funds in the last few years, which I think has been lost in a lot of the discussion. Now, the next big change, of course, happened in the 1980s, but it's more a part of this world of securitization, this world of the movement away from institutions owning mortgages to mortgages being put on markets. In the Tax Reduction Act of 1986, which sustained the mortgage interest deduction and removed the other interest deductions. So up to that point, you could deduct your credit card expenses. You could deduct your interest on your car. And this is because of the legacy of the 19th century, the legacy of thinking of interest as a form of business so this muddled idea of what is productive and unproductive exists in the tax code until 1986. And it's also in this moment that we see the emergence of the slicing and dicing that our two non-historian colleagues will no doubt talk about much more sophisticated ways. But the question I want to ask is, why do we care about giving access to home ownership? Clearly, home ownership is not the same as owning a farm. It's not giving someone a stake in the productive quality of capitalism, as in the 19th century. Why is home ownership important as a policy? Now, clearly it's not important just for shelter. If we're just about shelter, we could just provide housing for them, that we rent out to people. It's more than that. It has a financial value and a social value. Now, the social value is very complicated. What does it mean to own a house? To have the stakes in communities, to have your share of your community. We see it's important in the 1949 Housing Act to provide good housing to everyone. In the 1968 response to stopping rubber riots. And certainly we see it broadly in the 20th century as a marker of social stability and adulthood. And for working class Americans, there's certainly been a drop-off in the number of riots and strikes since people could have had access to their homes. Owning makes you believe in capitalism, or at least unable to resist it so completely. It's a marker of independence. And while that social idea continued, the reality of the financial value of owning your own place, owning your land, is not the same as it had been in the 19th century. Now, there are ways in which you can become that. You can borrow against your house for a business loan. And this certainly is important for many small business owners. Although, of course, in the last 20 years, since the emergence of credit cards, most small businesses start by borrowing against their credit cards rather than their homes. Now, what's more important, perhaps, for most people in their having their homes is the idea of seeing it as an investment, seeing it as something which appreciates in value. Now, this happens in a few different ways. Now, first of all, of course, there's the home equity loans. Now, in my book, I read about the importance of debt becoming fungible, of different kinds of debt becoming other kinds of debt, between installment debt and small loans. And in the 1970s, we see the emergence of the first time of home equity loans, which are much like the second mortgages, which are made illegal for these federally insured FHA loans in the 1930s. And these home equity loans become a primary way for homeowners to pay off other forms of debt. And so we shouldn't understand the mortgage crisis as something having to do just with homes, but with the ways in which people use debt in a myriad of ways in their lives. Now, the way appreciation is really important, people often argue, is that it's a very important way for the middle class to invest in housing and to appreciate their wealth. Yet when one looks at how houses move in value, on average, except for the past few years, they're actually terrible sources of investment. You would be better to put your money in almost any stock or any bond or anything else than to put it in a house. And we should better understand it as a form of structured saving, a way to force people to save and get very much. Yet, this is how people see it. They see it as a way to invest and to become wealthy. Why do they care so much about this? And I argue it's because for many Americans, there's few other ways to get access to what they see as the big money. You know, this sort of speculation that Steve was talking about in the 19th century persists until today. And it addresses the larger question of inequality, the larger question of why have wages stagnated for the last 35 years, and how should we help people get wealthy even though they can't make more money by working. And so we should see as an opposition between them credit and wages. What they can't make in wages, they can make in credit. And this is the easy policy answer for those of 1968 and after that. Give people access to houses, and they will make money. We need to have them enable people to have access to these, what we see as assets, which we'll appreciate. And it's in this moment that the confusion between savings and investment hits hardest, as people think they're investing, but really they're saving, and they move so much of their money into these things, which in fact do not make them all that much money. And for policymakers, there's a displacement between access to good jobs and access to easy credit. I mean, it's certainly easier to do the latter than the former. The question of wages within capitalism is far more intractable than the question of just giving people cheap access to loans. But that's where our federal policies have focused for the last 30 years. And it's that question which needs to be resolved or fully to rectify the current crisis. This question of massive inequality, this question of top and bottom. I mean, part of the crisis is that people are making less money on the bottom. That's surely true, that people look to mortgages as a way to get access to wealth. But it's also a problem for capitalism as a whole. With all that money concentrated at the top, where do you put it? You eventually run out of Microsofts to buy as you reach the market caps. Where do you put that money? You can't put it in China because you have no idea what's going on there. So where do you put all this money? It's not just a place for American capitalism, but for global capitalism as a whole. You try to put it in something that looks safe, something that looks like a secure asset, something like a mortgage. Because you can't make money in factories because the profitability of manufacturing has declined. And so it's not just a question of individual malfeasors, it's a question then of markets. It's a question then of capital, a question then of profit. Where does the money get put? And that question is more essential, and I fear not easily as answered as these other questions of access or clear governance and the like. It's a question of capital, and perhaps our esteemed capitalist colleagues will be able to answer the question. Thank you so much.